So we started self-managing our portfolio many years ago. And that's kind of one of the main ways we create value is having that operational control over our asset base versus handing the keys to a third party and hoping for the best.
Welcome to Multifamily Insights. I'm your host, John Casman, and I want to thank you for joining us for another great episode. You are getting some great value from this show. You already know what I'm asking you to do, right? Leave us some honest feedback with a rating and review. It helps us, but it also helps other listeners find this show for their investing goals. And if you haven't done so, be sure to hit that follow or subscribe button so you don't miss an episode. And we got a great show today. We're going to be talking to Jacob Vanderslice. They say you're the average of the 5 people you spend the most time with. So if you want to grow as a multifamily investor, you have to spend more time with other multifamily investors. And an easy way to do that is to join our apartment investing mastermind group today. Just go to casmancapital.com and click on the mastermind button. Now, as a part of this group, you'll get access to expert trainings, group coaching calls, industry news and updates, as well as all of our webinars and workshops, including our 3-hour workshop on raising capital. Again, if you want to be around other multifamily investors that can help you scale your portfolio today and grow your network, make sure you're a part of the Apartment Investing Mastermind. Just go to casmancapital.com and click on the Mastermind button today. Now, Jacob is the co-founder of VanWest Partners and a seasoned real estate investor since 2005. Now, he oversees the creation of self-storage investment portfolios and leads the investor relations team known for its exceptional stewardship and transparency. Let's welcome to the show, Jacob Vanderslice.
John, good to see you. Thanks for having us on.
Absolutely. Jacob, great to have you on the show. I went over your bio at a very, very high level. Why don't you take 2 minutes and fill in some of those gaps?
Yeah, we're full-time real estate investors. As you mentioned, I got out of the business in 2005. I was in the fire service, had a lot of time on my hands, and I started kind of dabbling in fix and flips and rentals, and quit my job, and I've been unemployed ever since. For many years, we did single-family fix and flips and rentals, a bunch of them all over the country. We'd buy deals at the trustee sales, we'd buy them off market, we'd buy them at the MLS, and that was our main line of business really from 05, 06 through about 14. And in 14, we got into commercial real estate. We did some adaptive reuse retail projects here in Denver. We did some townhome development, a little bit of multifamily. We did our first storage deal in 2015. And at the time, it wasn't really a strategic kind of fundamental pivot in our business. It was more, hey, let's try a deal out and see how it goes. And went okay, and we liked it, so we did some more. And over time, we evolved to being pretty much exclusively self-storage owner-operator. So as of today, we own 40 facilities, which I know is an oddly round number. It'll be 41, 42, hopefully in Q1, but today we're at 40. It's about 20,000 units and about 3.2 million square feet. We do some development occasionally, but most of our deals that we'll target are value-add existing facilities that are just inefficiently operated. Their expenses are above market, their rents are below market, they may not advertise. We'll buy these, we'll perform some capital improvements, but most of our value creation will come from the idea that we more efficiently operate these than the previous seller did. We self-manage our whole portfolio, and that's what we're up to.
I love it. Thank you for that, Jacob. Just to play some of that back, right? You talked about starting off in single family. Really prior to that, you were in the fire space, which we kind of glossed over, but you were in fire, I believe you worked for the fire department as well, and was an arson investigator. But beyond that, when you got into real estate back in 2005, started off with single family, doing some fix and flips, finding properties and rentals all over the country, buying these for really about 10 years, right? 2005 to 2014. And then 2014 started to pivot, getting into more commercial real estate. One of the asset classes you got into was self-storage, had some, good experiences there, did a little bit more, had more good experiences. And eventually you kind of transitioned to focus almost exclusively on self-storage. Today you have 40 facilities, 20,000 units, and focus on a value add strategy. Can we go back to 2014? Because I'm curious, what made you decide to transition from single family homes, which you were doing successfully for 9 years, to getting into commercial real estate?
We didn't stop the single family in 14. It ran in parallel for some years after. And in 14, we had this property we identified in Denver, and kind of an historic building, just vacant, undermanaged, and a guy that used to work for us back in our single family days. We reconnected with him to help us underwrite it. His name's Wade Buxton. And he said, yeah, I'll underwrite it with you, help you out. And then we're like, yeah, by the way, do you have any money? Do you want to partner on this thing? So we called up grandma. I think he got 50 or 100 grand. We raised some money and we partnered on this commercial deal together. And over time, we became equal partners, the three of us. So we really wanted to get into, bigger is not always better, right? But scale doesn't always necessarily equate to a positive outcome. You could scale and make less money in many cases. But we wanted to shift our overall strategy to being traders, meaning just buying and selling over and over again, which generates cash, but doesn't really generate wealth, at least in my opinion. We wanted to kind of shift our philosophy from being traders to being real estate owner operators and holding for longer periods. And I'll let you know whenever we hit our wealth goal, whatever that is. But I think our thesis on wealth creation is to buy assets that produce recurring, durable income streams, finance those assets responsibly, enjoy the benefits of real estate from a depreciation perspective, from a cash flow perspective. And then eventually, when it's appropriate, you monetize that value creation. So we at that time, we started kind of shifting our philosophy to being more long-term holders and more scalable large assets. And our first years of commercial were mainly adaptive reuse retail. So you find a cool old building in an urban infill location, you renovate it, you demise it to multi-tenant experience-based retail. You own it, you operate it, eventually you sell it. That's a great business, but it's hard to scale. There's only so many cool old buildings in your home market. And that's why we thought storage was a good vehicle. It's repeatable, it's got durable income streams. And I want to correct something you said earlier. Most of the deals have gone well. Not all of them. Both have gone well. We remember our mistakes and failures like they were yesterday, and the home runs you can kind of forget about and chuck up to lucky timing or interest rates or whatever the case might be. But we concluded that storage was a good vehicle to kind of accomplish that longer term, durable, recurring revenue strategy and building an asset base that you hold for a while. So here we are.
Jacob, I really appreciate what you just clarified there. And I wanted to go back to that point because I think so often, people will talk about scaling in multifamily and, they hear the why or scaling commercial real estate in general. And yes, there's more money and certainly there's more money that can be made on an individual deal. But you talked about the concept and it's almost, it's really at its core, it's about how you see the business and what you're actually doing, right? You talked about going from being a trader to being an owner to being an operator. And when you're a trader, people may not think of it in those terms, right? But if you're fixing and flipping, you're buying a property, fixing it up, you're selling at a profit. Some people would just say, I'm an investor, I'm a real estate investor, but you don't have that asset anymore, right? So you have to keep doing that thing. So you're just trading it versus holding on to that asset. And as you described it, you want to buy assets with recurring income that have the benefits of depreciation and all the other things that we look for, which really gives real estate the edge over other asset classes. And you weren't really taking full advantage of that, for that 9-year stretch. 2014, you started to do that. And that's when you said, you know what, while we're doing these in parallel, we actually should focus more on this. The other thing you talked about with the adaptive reuse, and for those who aren't familiar with that term, what you're talking about is, again, buying that cool property that maybe was whatever, was old school or whatever.
The 100-year-old busted warehouse.
Yeah, exactly. So some old warehouse, you're going to go in, you're going to completely re-envision what the use of that property is. And now you're going to make it, this beautiful brought to life property that is now a strip center or an apartment building, whatever it is, right? The challenge there, as you pointed out, is it's hard to build a sustainable business model because those properties are rare to find. Even if you do find them, you got to deal with the jurisdictions of the cities. There's a whole lot that makes it challenging to go in and say, okay, hey, every 6 months we're going to do this, or every 3 months we're going to do that. And that made you more comfortable doing self-storage because you could actually build a more predictable business model around that. So I just want to give a little context to a lot of the cool things you said, but also just help people understand why you had these realizations and made those adjustments in your business. Were you going to say something?
To briefly return to your trading comments, and I promise this is related, but bear with me for just a brief moment. So we do some online marketing, and If you want to invest in one of our deals, you fill out a web form and you get like an auto email with a link to click on it to schedule a call. So we had an investor fill out the web form. They click on that link to schedule a call. It shows up on my calendar. Give this guy a call at the start time, and he sounds pretty elderly on the phone. And so like, I'm not sure, going to be locked up with us for a while. And he starts telling me about his bio. And this guy's got a lot more money than I've got and probably will ever have. And really sharp real estate guy. And he asked me one of the most intelligent, profound, yet simple questions I've been asked by an investor, and kind of made an observation. I'm telling about our hold period, the IRR, the multiple, all the targets. And he's like, so just to clarify, how long you boys planning on holding these for? And I, 5, 7 years, and he's like, the problem with selling, right? And I'm like, no, what's the problem with selling? And he responds, you don't own it anymore. And I was like, wow, that is a profound, deep comment. The problem with selling is you don't own it anymore. And there's a time and a place to sell. But if you're just constantly buying, making better, and selling over and over again, it's this hamster wheel of just having to eat what you kill. So that was pretty impactful, that comment to me, as simple as it sounded. And we're certainly going to sell at some point, but we generally don't like to sell quickly. And that's the reason. You just quantify all the value that you thought you were going to create. You pay taxes, your cash flows over, and now you got to figure out a way to redeploy the money in a similar investment with a similar return.
Yeah, Jacob, I think it's a great point, right? And sometimes the simple things can get overlooked, but it's worth repeating. So I appreciate you stopping for a moment and just bringing that back up, because, yeah, you definitely got to build a business where, again, you talked about that recurring income stream. It's really, really important to understand that component. Let's talk a little more about self-storage. So I know this is obviously where you've pivoted and kind of focused the business. For you and from your standpoint, like, what is it about self-storage that's so attractive to kind of, make this the center point as an investor, but also for those passive investors who are looking to invest in these kind of deals? What's so attractive about self-storage?
Well, let me start by saying what's unattractive about self-storage. So first of all, there's this misconception out there that it's so easy, right? No tenants, no toilets, no problems, no fair housing laws. And that could not be further from the truth. Self-storage is operationally intensive. And to a degree, we're a retail-facing consumer business, almost more so than we are a real estate investment company. We have thousands of customers. We have hundreds of customers move in and move out every month. We have theft. We have break-ins. We're getting served DEA search warrants for somebody keeping drugs in their unit. We've got U-Hauls backing into gates. We've got all kinds of issues out there that come along with owning real estate. So it's definitely operationally intensive. No more so or less so than another asset class, but it's a kind of misconception that it's really easy. And that's just not the case. But to actually answer your question on a few reasons why we like it. So first of all, we like the ability to dynamically manage our revenue. So all of our leases are month to month. So we can respond real time to supply and demand changes, both at the unit level and the facility level. So for example, if we have a 10 by 10 that's really full, unit type that's really full, a 10 by 10, we can raise rates with a 30-day notice and probably not get a lot of move-outs. Likewise, if we have a unit type that's lower on occupancy than we want it to be at, we can drop rates on that, drive up occupancy, and then start increasing rates over time. So you can really pull a lot of levers, and to a degree, you can experiment in the business. And if the experiment fails or doesn't work, you can course correct quickly. The second reason we like it is we like the granularity of the revenue streams. We're relying on thousands of customers to pay us, $30 to $300 a month, depending on the unit type. So we're not beholden to any one large user or any one large tenant. An example I'll often give is we have a retail building here in downtown Denver. We have a brewery in one of our units, and all in, they're probably paying us about $40,000 a month in base rent and CAM charges. That's a lot of money. And if they fail, it's going to take us a long time and cost us a lot of money to find a new tenant, right? Tenant improvement allowance, leasing commissions, debt service on a vacant space, you name it. But in storage, if a $100 customer rolls over on you, you can get them out pretty quickly. You broom clean the unit, and you put a customer in there that's hopefully going to pay. So we like the tiny bite-size granularity of the revenue streams, but in aggregate, with thousands of units, those become fairly meaningful. So we can dynamically manage our revenue based on seasonality and supply and demand. And from a risk profile, again, we're not beholden to one singular user that can make or break our deal. We're beholden to thousands of customers that are paying us kind of bite-sized chunks of rent every month. So those are a couple of reasons why we like it.
Jacob, I think that might be it is probably my favorite answer I've heard on self-storage. One, you said something that just really was visual for me. You said it's not even really a real estate business. It's more of a retail focused consumer business. And this is a great way of looking at it. And as you went on to further discuss it, given those examples that you're not really beholden to one client, right? It's not like on the brewery, they're paying $40,000. If something happens with that brewery, it's going to take a long time to, one, adjust that space, to get someone new in, leasing, contracts, all of that, right? It's probably a multi-year agreement. So they have a lot of influence and power in that situation. Even with multifamily, typically you're talking about leases where maybe it's $1,000, $1,500, whatever it is, but you've got hundreds of them, but you have people, you have fair housing laws, you have there's so many regulations that are involved there. With this, you're talking about maybe $30, $50, $100. So it's really more about just marketing and trying to find those people in the operational side of running that as a business, as opposed to, okay, hey, we signed a lease, we can kick our feet up, we're good now. Let's just check in to make sure nothing's broken. So I think it's a really good way of thinking about it, right? It really is more the operational side, recognizing that you're gonna have these different things that come up. On the flip side, you did mention the toilets and termites and things like that. There is typically not, plumbing that's involved that you have to deal with. And, some of the overhead costs aren't as drastic. Can you talk a little bit more about that as far as just some of the expenses you do have to plan for when investing in self-storage?
Yeah, it's definitely on the operational expense side and the OpEx side. It's a little bit easier and cheaper to operate than a multifamily building. So if you have a 500 unit apartment building, obviously you've got 500 bathrooms at least, 500 kitchens, sets of appliances. Those things break often. People live there, so they get a lot more upset if there's a leak or something goes down. And in a self-storage facility, you generally have a men's and a women's bathroom. You've got a leasing office, maybe a break room for your staff. Other than that, you're leasing metal boxes. So from a repair and maintenance and operational expense perspective, it's a little cheaper than multifamily is to operate. But the big things that we think about that kind of transcend real estate asset classes when we're buying a deal today in this environment, we talked about this a little bit before we started recording. One big one is property taxes, right? You're buying a deal it's got full service leases, meaning the tenants obviously don't pay for any building expenses like taxes or insurance. If you're wrong on your property taxes, you're very wrong on your total return for the deal. If you think you're paying $100,000 a year in taxes, year two shows up and you get assessed at 150, that's $50,000 to the bottom line. It just goes away. You lose $50,000 a year in net operating income, and that's a material impact to your overall value. So that's one thing that we're thinking about a lot and trying to quantify and understand when we're either building or buying a new deal. Another one that didn't used to be as much of a risk factor, but very much so is today, perhaps more so than property taxes, is insurance. Insurance, as we all know, listening, has gone through the roof, especially in coastal markets. The increases we're seeing are substantial. And if you didn't underwrite that, it's just like property taxes. It's hitting your bottom line. It's a dollar for dollar reduction, your net operating income. So those are kind of two big factors that we look at. Other things we're thinking about from an operational expense perspective are staffing costs. That's been a big challenge for us the last few years. It's really, as we all know, it's really tough to find talent. It's really tough to retain talent. We've got an on-site manager that we're paying $18 an hour to in a given submarket. They may not show up to work the next day and just completely ghost you because they got a $2 an hour increase at the Amazon warehouse across the street. Never hear from them again. It takes you forever to find somebody new. So the impacts of staffing, not only from a cost perspective, but an operational perspective on just running the facility has been a challenge too. So I would say those are kind of three things that among many that we think about a lot on the expense side, are taxes, insurance, and salaries and wages.
I appreciate that, Jacob. Just understanding, again, similar challenges that many multifamily investors and other business owners in general are facing, but taxes, insurance, staffing starting to have some issues there. But on the OpEx side, certainly not the same challenges when it comes to some of the utility costs and some of the other costs that are involved. You mentioned earlier that your business plan is really focused on value add opportunities and that value add coming more from the operational side. Can you just go into a little bit more detail as far as how you implement a value add strategy for self storage?
Yeah. So among several things we're looking at when we're evaluating new acquisition is we're looking at the in-place rents relative to where rents are in the market. We're looking at if the current operator or owner advertises, do they market? Do they have ancillary income streams like late fees, U-Haul truck rentals, merchandise sales, tenant insurance? So we're looking at all these factors and we're asking ourselves, is there a good story to increase revenue on this facility with a more efficient operational platform? And if the answer is yes, we'll target the acquisition of that property and make an offer. And then if they accept our offer, we'll buy it. So most of our value creation will come from really not dissimilar to multifamily. One obvious one is taking an empty unit and putting a tenant in there that's paying, right? So occupancy growth, that's one factor. And the second one is rent increases. So if you've got a bunch of customers that have been there for 5 years, they've never seen a rent increase, they're already below market. Most of those customers are probably going to digest a rent increase fairly well, as long as they still need their storage unit, because they're going to have to go across the street somewhere else and probably pay more. So rent increases, filling up vacant units through better online marketing practices and advertising, but also controlling operating expenses, running these more efficiently, rebidding snow removal and landscaping contracts, staffing it as lean as you possibly can, getting national vendor accounts so you can save money in aggregate when you're getting somebody to bid maybe 10 projects at once versus one. So those are kind of a few examples of how to create value. And the reason we self-manage our portfolio is not because we're good at it necessarily, or because we're smarter than maybe the REITs are or larger operators. The main reason we self-manage is we just care more and we pay a lot more attention than a third party would. It's human nature. If you own the deal and you're running it, inherently you care about your deal that you own more than you do somebody else's deal you might be managing. So we used to use third-party management companies, and big surprise, over time after the honeymoon was over, we found our interests were misaligned. They weren't raising rents like we would have. Expenses were bloated and non-transparent. So we started self-managing our portfolio many years ago, and that's kind of one of the main ways we create value is having that operational control over our asset base versus handing the keys to a third party and hoping for the best.
I think one thing that has always been interesting to me or appealing to me about self storage is when you talk about the operational side, and this goes back to your point about being more retail focused consumer business. You know, the thing that is challenging for, let's just say, multifamily is really on the operational side. You have to fix stuff, right? I mean, there's stuff that breaks. You've got to have maintenance. You've got construction. You need to go in there and renovate units. And there's a lot of coordination and conversations that happen. That is less important, you know, to an extent you have a little bit of it there, but way less a part of the operational component when it comes to self-storage. So I say that to say, I think many investors can operate self-storage. Not saying they all should, but they can if they're decent business owners or have that business mind. Whereas with multifamily, it's really challenging if you don't understand the construction side of things. If you don't understand what something should cost on a, you know, per square foot basis, if you don't have vendor relationships or you don't have the crews that can come in, it's hard to just decide you're going to be that owner operator. So a lot of investors obviously do rely on third party management, but those challenges are still there that you kind of described. Whereas in self storage, to your point, you don't necessarily have to be a world class operator to care more than the alternative options that exist. So I really just appreciate you share that. Just give some frame of reference to, hey, if you can run a business, if you can understand and put together a business plan, and yes, you've got to follow up and communicate with the different residents, or not the residents, but the different tenants, so that they understand, hey, here's what we're going to do. We're going to be pushing this up 10%, or we're going to take that down. There's still a lot of coordination and conversations that take place, but I also assume there's plenty of like resources, technology and databases and things like that you leverage as well. Is that fair?
Yeah, there's a lot of platforms that we use out there on the software side. Some of them are third-party services that we pay for. Others we design internally from the ground up. One of my partners is a software engineer by training. And just a couple of brief examples. Starting about probably 2015, 2016, he built a tool that scrapes all of the asking rates from thousands of facilities around the country. And this lets us do a couple things. So it first of all lets us see historic pricing trends. And certain markets have more pronounced peaks and troughs based on seasonality. So in Ohio, right, you've got the seasons. It's cold in the wintertime. You can see pricing go down in the winter and kind of spike up in the summer when everybody starts moving again. Whereas in Florida, those seasonality trends are less pronounced. But you can also see the impact of pricing when there's a hurricane, for example, that comes through the southeast. You can also see the impact of pricing if a supply shock hits a given market. So a bunch of operators build at the same time, rents go down, occupancies go down, you can see those pricing trends come down. So this tool allows us to kind of normalize these historic pricing trends and make a more informed acquisition decision when we actually buy a deal. And then post-closing, it lets us more accurately manage our revenue because we have a real-time feed on what competitors are charging. So if we see a guy 2 miles away and he doesn't have any 10 by 10s on his website left, we'll know, our software will catch that. We'll know that his 10 by 10s are probably full, and we can probably start pushing pricing a little more aggressively on our 10 by 10s. And likewise, if he's got a bunch of 10 by 10s and he's dropping rates, we know we have to do the same thing to actually get customers attracted to our store. And so it lets us make a more informed acquisition decision when we buy a deal, and it helps us more efficiently operate our portfolio post-acquisition because of that real-time data feed that we can get. So that's kind of one example of one of the tools we use.
That's a great example. And I think it's so helpful because obviously there's real-time and different dynamic pricing models that are in multifamily as well. But when you create your own, you obviously have a lot more leverage over how to use it. And then kind of going back to a big difference, you don't have the government and other folks necessarily trying to fight you on those tools where, right now, Real Pages still a big battle there.
Not yet. Maybe that could be coming someday.
Yeah.
Maybe less likely now, but that could be on the horizon. We'll see.
Yeah. So I think the one other challenge that, your typical investor has is just understanding some of the things that impact self-storage pricing. So we've seen a ton of new supply come online in multifamily, and in many markets that has pushed rents down. In some markets, mainly here in the Midwest, hasn't been as big of a challenge because there wasn't as much new development that took place here. With self-storage, what are some of the things you look for? Are you looking at supply? How does that start to impact kind of your numbers and your figures? And what are you seeing as far as some recent trends?
Yeah. Beyond normal real estate fundamentals like rents, location, and, population growth, median income, the main thing we're looking at, or at least on a cursory level, initially underwriting a potential acquisition, is supply and the supply ratio. So in self-storage is expressed in square feet per capita. So how many square feet in this 3 and 5 mile trade radius of self-storage is there per person? So nationally, there's about 8 square feet per capita. And you might infer that a market that's over 8 is oversupplied and a market that's under 8 is undersupplied. And that's not exactly true. What we're looking at is not so much the supply ratios as it relates to the national average. We're mainly looking at supply ratios on where they're at today compared to where they've been historically and where they might go. So we've got deals in some markets that have like 25 or 30 feet per capita, which is a lot more than 8. You might think, why are you doing deals there? Well, they've been that way for a long time. Nobody's building because the rents are too low, and most of the facilities are 90% occupied. So that's a market we might want to be in because we don't see a story for new supply coming. The rents are so low that more of the population can afford to store. So we're comfortable buying a deal in a market that, compared to the national average, has a lot of supply. What we're looking for, though, whether it's 25 feet per capita or 3 feet per capita, we're looking at what the objective and subjective risk is of that supply increasing in a short amount of time. So you could buy a deal in a 5 foot per market, square foot per capita market that may seem like a good acquisition decision, but based on the supply pipeline, maybe it's going to go to 8, 9, or 10 feet per capita in the next 24 months. Then you got a big problem because you're in a knife fight with a bunch of other developers that probably have a cheaper cost of capital than you do, that are dropping rents to fill up their units, and it's a race to the bottom. So we can't obviously completely defend against the risk of new supply, but it's something we try to quantify and understand as much as we possibly can. And that's the main risk in this business beyond normal real estate risk like cap rates, interest rates, rents. The main risk in this business is supply and the introduction of unforecasted shocks in supply that can really impact your deal in a negative way.
Jake, appreciate you sharing that great information as usual. Really understanding not just the national average of, square foot per capita, but recognizing the historical average of that market and understanding the trends that may impact it, particularly when it comes to new supply. That's really important just to understand. And new supply is certainly one of those things that you've got to pay attention to no matter what asset class you're looking at, because it just goes back to, just business 101, right? The law of supply and demand. So when there's more supply, you're not going to be able to charge as much for it. When there's less supply, you can. So just understanding that, certainly there's data points and things to find that information, but understanding how to interpret that data is really where you got to focus the education. Jacob, for folks that want to learn more, they can go and visit your website, vanwestpartners.com. So we'll make sure we link to that in our show notes. Right now, we're going to transition to our round of insights. Jacob, give me a failure or an apparent failure that sets you up for later success.
Well, I think all the failures have been more of a learning experience than the successes over the years. You can chalk up some of the home runs to luck, to market timing, right place, right time, low interest rates. But you remember the failures like they were yesterday. And we often like to say that we're not any smarter than we used to be. We're just less stupid. We make more mistakes every year and we learn more of what not to do than what to do. So looking into the new year here, I'm excited to be a little less dumb in the real estate investment space. One specific deal that comes to mind, I guess two briefly. Many years ago, we built a house out of shipping containers. And at the time, we thought we could crank these things out, do them cheaper, do them faster. And it turned out it took longer and cost more money than it would have cost just to stick build it. And all we learned was don't build a house out of containers. That was it. And I'm sure there's plenty of people around the country that are doing it and made it work. We couldn't figure it out. So all we learned there was just don't do that again. And then secondly, in the storage front, we had the proverbial 1031 kind of gun to our head. We were in a 1031 exchange. We had a big tax bill if we didn't find a replacement property. And we bought a storage deal, myself and my two partners in Iowa. And it's not a deal we would have normally bought. And it wasn't a great deal, but it was the only one that we identified. So we closed on it to defer our taxable gain. And big surprise, it never performed. We never got the NOI growth in place like we thought it would. It was kind of too small to be efficiently operated. And not only did we sell it last year and pay our tax bill, we sold it last year and actually took a loss on our cost basis. So don't let a 1031 kind of wag the deal. Don't let the 1031 tail wag the deal dog. Said otherwise, don't buy something in an exchange you otherwise wouldn't organically buy. That's one of the many hard lessons we've learned over the years.
I appreciate that, Jacob. Give me the book you've recommended or gifted the most in the last year.
There's been a couple, and before I give this to you, I'm really bad at reading business books. I've read all the main ones, but I just can't get through them for whatever reason. I mostly stick to historic nonfiction, and the most recent one that I've read, it's like the third time I've read it. It's called Into the Silence by Wade Davis. And it's an account of the initial 1920s British expeditions to find Everest and climb Everest. And all of these guys on these expeditions just came out of World War I, which is one of the most horrific conflicts in human history. All war is terrible. World War I was just awful. So these guys had seen and done things that they can never forget. And you throw them into the Himalaya, trying to find this mountain that no one's ever laid eyes on before. They kind of know where it is. And the trials they went through, the frostbite, the casualties they went through, it just kind of puts your challenges in the office in perspective. Like, oh, we missed that deal today, or we had a bad month in occupancy growth. It's like, it kind of reminds you, well, I could be in the Himalaya in leather boots in 1920, with my toes freezing off in a blizzard. And I think it's a great book just to kind of put things in perspective. It's fascinating. It's a great account of just major adversity and just kind of the human experience and the human challenge.
What was the name again?
Into the Silence by Wade Davis.
Into the Silence. All right, awesome. Appreciate that. Give me a digital or mobile resource for our listeners.
We use a software platform called Slack for our kind of intercompany communications. It's great. It saves all the messages. You can create different channels based on the topic. Our entire operations team are on it. The office is on it, our Denver office folks. And it's just a good tool to kind of house everything for internal communications. And it's a good way to reduce email. So Slack is a good tool.
Slack it is. Give me a daily habit that helps you stay focused on your goals.
Let's see here. A couple things. I live and die by my calendar. I block time on my calendar. Everything lives on my calendar. And it's kind of a crutch to a degree. If I didn't have that, I would be completely worthless. Not that I'm worth much, but I'm more worthless if I wasn't kind of running the calendar. And the second daily habit, this is only a 2024 thing, but I've been doing daily workouts all year. I haven't missed a day. And I've tried to do 3 days a week or, do this training plan. And just the rules around that didn't work for me. It was just block time and do a workout. You got to do it every day. And that works for me. And so far, so good. Hopefully I can keep it going in 2025.
Love it. Great one there. Give me your number one insight for self-storage investing.
I'll give you a number one insight for, I guess, investing in general. And, we'll talk to a lot of investors who have been listening to podcasts, going to seminars, reading books, taking classes, you name it, trying to educate themselves. And the best education you can possibly get in the real estate investment space is to do a deal and take a risk. There's no perfect deal. There's no home run. And frankly, the deals we've done over the years that turned out to be home runs felt kind of thin when we bought them. And the deals that felt like home runs in our model turned out to underperform in many cases. So there's no perfect deal. And the greatest asset you have in wealth creation in real estate is time. It takes a long time. And if you're not in the game and you're not taking that risk, you're missing out on the benefit of that time. So my advice is take a risk. Whether you've been considering passively investing in a fund or a syndication, buying your first fix and flip, buying your first rental property, there's no perfect deal. Try to quantify the risk and try to protect the downside, but take action and take a risk.
Appreciate that. Take a risk. Jacob, we're going to go in a different direction here. You're based in Denver. Give me your favorite place to grab a bite to eat.
Well, with two boys that are 5 and 6, the dinners out have kind of diminished the last couple of years. But there's a spot. It sounds kind of like a funny name, but there's a restaurant in Denver called Quality Italian, and you think it's like a checkered tablecloth, hole-in-the-wall Italian place in a strip mall, and it's not. It's really nice. The food's amazing. The atmosphere is awesome. We'll have investors coming to town. It's kind of the main place we take them. I think there's one in New York too, but Quality Italian is, if you're in Denver, it's not like a Denver-centric place. You don't think of Quality Italian or Italian food for Denver, but it's awesome. Alternatively, Buckhorn Exchange, which is like a game place, oldest restaurant in town, 100-something-year-old building. They serve like rattlesnake and elk and antelope and all kinds of crazy stuff. So those are two spots to check out.
What was the second one?
Buckhorn Exchange.
Buckhorn Exchange. All right. Quality Italian and Buckhorn Exchange. Awesome.
Got it. You got it.
Jacob, really enjoyed our conversation, man. Just listening more about kind of your background and getting into real estate, focusing on single families, doing those fix and flips for 9 years and deciding, we want to transition from being traders to being owners and operators. We want to build equity. We want to get the income. We want recurring income at that. And we want to take advantage of all the advantages that commercial real estate has to offer. Getting into self-storage, being able to scale your portfolio there, and just sharing what some of the pros and the cons about self-storage investing. I love what you said. I mentioned it before, but the view of focusing on retail-focused consumer business as opposed to just another real estate asset class, I think really helps to give people some context as far as what it takes to really be efficient and effective as a self-storage operator. You all are vertically integrated, operating the assets yourself, developing your own software and tools, and it really helps to think about what value-add investing looks like in the self-storage space. For those who want to learn more, they can check out your website, VanWestPartners.com. Jacob, I want to just thank you again for being a great guest and coming on Multifamily Insights. We look forward to staying in touch with you, and I hope you have a great day.